The broadcast is now starting. All attendees are in listen-only mode.
Welcome to Navigating Uncharted Waters, commercial real estate lending in the midst of market disruption. John, I thought we were through with market disruption. I read an article saying the crisis is over.
Well, there's certainly some interesting things going on in commercial real estate today. We have an outstanding panel today. Tim Mazzetti, Vice Chairman of
Whoa. I thought I was introducing the panel. Taking away my job. Tim Mazzetti, Vice Chairman, CRE. Tim, welcome.
Thank you.
Brad Salser, President, Redstone Funding. Brad, welcome. And off camera, who will be on camera shortly, Chris Leff, Managing Director of CRE HTLF. Those are a lot of words there. And John Winnick, CEO of Clark Street Capital. John is a market maker in helping lenders acquire and diversify their loan portfolio. Is that a fair statement, John?
Couldn't have said it better myself.
All right, very good. Hey, we have a poll question. First of all, thank you all for joining us. We appreciate it. John, this is the third one you've done, and you do a great job, and you have great panelists. So let's get into it. We have a poll question to help the panelists tailor their remarks and get an idea where we are today. In your portfolios, what area are you starting to see signs of credit deterioration? Construction, C&I, office, CRE, nah, we have no deterioration. %42% office. Boy, that was certainly different than the poll we did the other day, John.
Yeah, this just seems more in line with what I expect. We'll actually see the same question shortly, but you can see the group that's attending this is a little more worried than, say, bank CFOs are.
That's right. Well, it's definitely the ground. Hey, John, I'm going to turn it over to you. I guess housekeeping, please ask questions. There's a couple ways to do it. You can do it through the dashboard interface, or you can send an email to joseph@comereport.com, and we'll bring that up. If you come up with something outside of the webinar that you thought of, we will have all their contact information, or just shoot it to Joseph, or I will be happy to get it to them. And with that, John, take it away and tell us what's happening.
Great. Well, thank you. Thanks, everyone. Thanks for this great panel. This is our third in this series of webinars, and this may be the best one yet. We'll see. First off, just want to kind of give you an overview with where we stand in the banks currently. If you're in the banking industry, or if you're interested in the banking industry, I highly encourage you to read the FDIC's quarterly bank profile. Those are the most comprehensive overviews of the entire banking industry, because it includes all banks. And they actually break out large banks and community banks, so you can see where the differences are. And this is actually from the report last week. You can see by any objective measures, the balance sheets of banks are near pristine. NPAs as a percentage of assets are at 40 basis points, near record lows. You'll notice in the comparison from prior quarters, because of CECL, the restructured loan and lease categories continue to decline at banks. Eventually, that number will be zero. But currently, depending on how you measure it, there's a little less than 200 billion of problem loans in the banking system, and on a percentage of assets, it's about 40 basis points. Obviously, this is good news. I guess the bad news is if banks go back to normal levels of non-performing assets, you're going to see a 2 to 3-fold increase. And on this chart, I've given you where we were pre-crisis, where we were kind of in a normal environment, 2014, 1.25, and where we were at the peak of the financial crisis. We were at almost 4% NPA. So, we do expect the number to get bigger. Certainly, as that happens, the shorts will certainly pounce. We could give you article after article about who's warning about commercial real estate. Morgan Stanley is probably the most bearish. They're the only group that's really predicting a 2008-like CRE price decline. In our view, the deterioration in asset quality is going to be very slow because of all the COVID stimulus out there. And it's going to take a while before you see the asset quality deteriorate. From our perspective, office, senior housing, small business loans, CRE loans seems to be the focus. I would say office and senior housing are a big 1 to 2. And you saw that in the poll question with office being roughly 42%. Next slide, please. Now let's delve into office. A phenomenon in the office market right now is a fairly large gap between contractual occupancy, which is still well into the 80s. I think it's like 83%, and actual physical occupancy. Castle is a company that does the security for literally thousands of office buildings, and they've been tracking the kind of return to office. Obviously in the depth of the pandemic, there was probably 10% physical occupancy. Well, physical occupancy is back to about 50%. It has stalled as of late, and vacancy rates continue to creep up for 6 straight quarters. It's our view that this gap between physical occupancy and contractual occupancy is unsustainable, and that will converge. So you can't have a 40 basis point difference between 40,000 basis points difference between physical occupancy and contractual occupancy. There's still some return to office momentum. I know Meta recently announced 3 days starting, I think, in September. Amazon did the same. So, we think there's still going to be momentum to bringing people back to the office. Next slide. As you go to the delinquencies for commercial real estate and occupancy, you can see kind of these are the top markets. So still very little vacancy in places like San Jose, Seattle, Boston, etc. But as you get to the other cities, things are certainly trending towards a higher degree of occupancy. Meanwhile, office delinquencies are continuing to rise, and the May data that came out was the largest jump in office delinquency loans in some time. Next slide. From the bank perspective, again, I don't think this speaks for all banks and all bankers, but there were 2 recent surveys about banks and what they think about credit. The one on the right is probably most notable. This was a survey from Piper Sandler as of last week of, I think, 90 bank CFOs. And basically 2/3 of bank CFOs have seen no signs of deterioration, which was somewhat surprising. And you could see very low numbers in consumer, CRA, C&I. DA Davidson did a similar study. You could see office was certainly elevated, but other areas were fairly low. Some differences between what banks are saying and what bank investors, which is somewhat noteworthy. Bank investors are a little more worried about C&I and consumer than banks themselves. With that, next slide, we'll move over to our good friend Brad Salza.
Thank you, John. I appreciate it. I mean, to give it context, I always like to know what we're talking about in the CRE multifamily world. And we're talking about $4.5 trillion worth of debt. I know some other figures are out there at a higher number. I don't think that the metrics they're using are as accurate as this $4.5 trillion number that we're using. And then we take the pie and we figure out who's got the pieces of it and who maybe have some vulnerability and who might report strong earnings at the end of the year. And banks represent 38.6% of that pie. So the majority of debt is held, commercial debt is held by traditional banking institutions. I mean, then we break it down and we can see agency GSEs. We know with everything going on in multifamily, they represent 21% of it. We've got CMBS in there at 13.3% and life companies at about 14.7%. We've got some other debt funds in there, but the bulk of my work at Redstone Funding is focused in the bank sector, where we see a lot of opportunity ahead. Perhaps we'll figure that out in this call today.
Next slide.
And this slide, the significance of this slide, besides those pretty colors, is simply the fact that commercial real estate values are falling. And that certainly is inevitable when you bring in for the first time since 1980, the highest interest rate increase we've seen. And, we've got also headwinds with operating expenses besides, on the NOI side. But here, and it hasn't dropped this much since September of 2010. So we do see values falling. We'll talk more about it this afternoon, but clearly MSCI is coming out this way. Green Street shows 15% decline in value. We'll see how low we can go, but that's where we stand today. Definitely on the way down. Next slide, please.
Tim, I know you're in special servicing. Tim has been in special servicing for as long as people have serviced commercial loans. What are you seeing? You can see the slide coming up. CMBS delinquency rate shoots up to a big jump. Maybe you can kind of comment on that.
Yeah, this is a much shorter period as compared to what Brad just went through, which is going back 15 years. This is just over the last, basically the last year. If you brought the graph out 5 or 10 years, it would probably more closely mimic the drop in values and the big run up in values after the pandemic in the early 20s. And what's interesting for me here, obviously, office is the red one, which you see a significant increase, which mimics what Brad showed. And then retail is having some issues. Multifamily, ironically, which is the yellow one, is showing a decline in delinquencies, but I think that's a little misleading. We were having a discussion yesterday between our group, and we all felt that this may be a lag, that the operating expenses on multifamily and the flattening out of rent increases or even potentially rent decreases, we're going to start seeing an impact, I think, in multifamily over the 6, 12, 18-month period going forward.
Along those lines, I'm going to jump in, Tim, real quick, because it blew me away a little bit. NMHC just came out. I don't know if you all saw it today, that insurance costs are up 26%.
Huge.
I've heard up to even higher than that. But I do think we're going to start seeing some real strong headwinds in the operating expenses of all product type. But I think it may be hitting multifamily, who's been at the top of the list particularly hard.
Yeah, and go ahead, John.
Yeah, the other thing that came out, I think it was in April, but the gap between renting and homeowners is about $1,200. So I think that does bode positively for multifamily, since it's more likely that apartment rents will go up than home prices will fall. So that's another phenomenon that is probably benefiting multifamily.
Next slide. This is an interesting one, but again, it's going to tie in. The next two slides are going to tie into the general topic of today's webinar, which is we've got a perfect storm coming our way, which is why you see so many negative headlines of commercial real estate. The availability of capital right now is about as low as it's been since the great financial crisis. And again, look at what happened during the pandemic just a few years ago. Obviously, capital dried up. No one really knew what was going to happen during the pandemic. It came back in a hurry, which also, again, mimics the graph that Brad went through, and a significant increase in values across real estate in a low interest rate environment. And now you're seeing a significant drop. Next slide, again, tying into what this one has. We're basically seeing underwriting standards getting very tight. And Brad and Chris are going to talk a lot more about it during this session, about how they look at commercial real estate deals and how they underwrite them. But obviously, the combination of less capital, tighter underwriting standards, and what I call a confluence of both credit issues and a huge increase in interest rates are creating that potential for a perfect storm. Certainly in office has got some significant headwinds.
Excellent. Well, thanks for that presentation. We're going to start with Chris Lepp. I've known Chris for a long time. He started his career in workout in 2008, and he's now head of commercial real estate lending for HTLF, publicly traded bank headquartered in the Midwest. Chris, how has your viewpoint on CRE changed as of late?
Yeah, no, interesting times for sure. we're a little bit of an outlier in the regional bank space as we've remained active throughout the volatility over the last 9 to 12 months due to accelerated rate increases. And we're looking at it as an opportunity to win new relationships that might have taken years to get in the door. A lot of my competition is saddled with bloated portfolios that aren't seeing payoffs. And, frankly, 50% of the regional banks, I'd say, are really not actively lending today. So again, presenting that opportunity. We've taken a more conservative approach from both the structure and pricing standpoint, underwriting debt yields north of 10%, leverage, below 60%, and actually closer to 50% for construction deals. Pricing is reasonably higher than it was 12 months ago. We're pricing bridge and term debt in the high 200s, low 300s. And, that was really a low 100 or a high 100s, low 200s a year ago. And construction pricing in the high 300s, even touching 400. Deposit relationships have always been important, but they've taken on even greater importance after the disruption in the first quarter with the bank failures. And it's basically become a requirement to lend. We've stayed open for business all along. It's taken a long time for borrower expectations to adjust to the current market. But the larger, regional and national developers and investors have seemed to have gotten the memo on what it takes to get a loan today and, adjusting their leverage expectations accordingly. So, we expect to continue to stay active. I started here a little more than 2 years ago and had the benefit of a portfolio that was not heavily saddled with commercial real estate. So we have a long way to go in terms of the growth that we can provide. But we're being incredibly opportunistic, not just with the opportunities that we're looking at, but at the relationships that we're looking to build.
Chris, is it feasible that you would do a commercial real estate loan without deposits?
Feasible? Absolutely. I mean, it can certainly happen, but, there's going to have to be, I'll say other qualifying factors and reasons to be considering that. Funding is important for every bank right now. Real estate is a heavy user of capital without typically a high deposit base. So, it takes on more importance now. But, historically, we did plenty of deals where we weren't getting anything besides an operating account.
Got it. Tim, obviously, you've got a lot of these loans. We all hear about these maturities that are coming up. In a lot of cases, the properties are fine, the borrowers are fine, nothing's really deteriorated. You just can't make the numbers work at today's interest rates. We all saw that example in the Wall Street Journal where a multifamily property went to foreclosure, partly due to a spike in rates from 3.4 to 8%. Tim, how are these special services going to handle these loans that can't be refinanced?
Yeah, it's a good question, John. We talk about it all the time. This is really a maturity issue more than anything else. As you pointed out, even in office in certain cases, because the contractual occupancy is still up there, the floating rate deals are the ones that have a huge issue because many of them are shorter term. And to the extent that they're coming up for renewal in the next 12 to 24 months, trying to renew in a market that's 400 or 500 basis points higher is a real problem at the same time as potentially physical occupancy has gone down and contractual occupancy is definitely headed down. So it's a real problem for us as a special servicer. What we're looking for in many cases, and a good portion of our book is CMBS. And as you all know, the restrictions in a REMIC requirement are much higher than what Brad or Chris might have in a portfolio lender environment, where they have a lot more flexibility to try to figure out workout strategies. In our case, what we're trying to do is work with a borrower, see if they have additional equity that they can put into the deal or pay down the loan, look at extension options, look at ways to keep the loan alive. But obviously, additional capital has to come in. To the extent that additional capital is not available, the borrower is going to walk, doesn't have the ability to raise it, or the property is really headed downwards. We're trying to keep the existing debt in place at a lower rate and to use that as a way to liquidate the asset at a higher level with lower rate debt in place.
Yeah, and it seems to me that the easy workout that banks had the last few years, where you put a little pressure on the borrower, you say, look, we're not going to renew your loan, go find another bank. 3-6 months, that loan gets paid off. That's not happening now. I think that, lenders who do work out credits, obviously they can always sell the loans, but they're going to have to be prepared for a 2 to 4 year hold. And I think what you're seeing is payoffs going down. To some extent, prepayment speeds have free fallen. Brad, you obviously have your own portfolio and you're looking at purchases. Are you seeing payoffs on loans decline in your book? And are you making a longer assumption as far as hold periods for buying a credit?
John, I mean, that's kind of at the crux of what I do every day in underwriting. And I was amazed in the last 8 years, the bleed off in our portfolio. And it wasn't even our borrowers refinancing into this low interest rate environment as much as it was them selling their assets because of the cap rates that they were achieving the last, 5 to 8 years. So, my WAM in the portfolio has been no more than 18 months, which is much shorter than I would like it to be. And now in my new underwriting, there's only one way to look at it because the debt I'm looking at is low interest rate, and that's a relative term, 4.5% fixed rate paper for 40 months. And I have to take it all the way out to maturity because if I'm that borrower, I'm going to keep my 4.5% rate for that full term. And then hopefully rates will be back down and I can get out of the credit. So it has changed. I found it should have changed dramatically. And it's interesting, Tim, you're talking about keeping the debt in place, but does that mean new equity still got to come in just from a different source? And will that equity come in? Brookfield just gave back $784 million in LA. Blackstone had 270 million. I mean, they're starting to walk pretty dramatically from some of this office product in particular. So,
well, that's a great indication from some of the most sophisticated and largest global investors of office that when they start throwing the keys back, they're very, very concerned. Again, it has to be market specific. Downtown LA is one of the worst markets we have. Downtown San Francisco is a close second. Certain parts of New York, and certainly the older B and C, 20, 30-year-old New York office that quite frankly is obsolete. Those, to your point, John, a workout could be holding it for years because there's not a lot of liquidity in the marketplace. Who's going to come to the table with additional capital? It may end up having to liquidate it at the value of the underlying land.
Yeah. Brad, certainly, I'd love you to touch on pricing on loan sales. I want to congratulate you. You won a deal recently. I know we'd serve on panels together and you bitch and moan at how good the pricing is. So it does seem you've seen the market move your way. Could you give me some color on what you're seeing on loan sales?
Well, fundamental to this whole exercise that we're doing today and that I've been doing is rates are up so dramatically. And back in March of last year, when we were all worried whether we were going to move from 25 to 50 bips up at the Fed rate, I kind of studied it going back into 1955 to March of last year. And the average, and I'm using prime rate because it's so transparent, easy to follow. The average prime rate from August of 55 to March of last year was 6.8%. Mm-hmm. And yet the average prime rate from the start of the Great Recession, which I peg is 12/15 of 07 till March of last year, was 3.75. So 14.2 years, we are in a historically low interest rate environment that allowed us to pay a 4 cap for, we don't even have to talk about Chick-fil-A. You 4 cap for even less credit than that. So, it's gotten tricky. I've seen it, pricing move about 10 points, frankly, about even a little more than that in the assets we're buying. And again, it's because they're not paying off in 18 months. We're taking it all the way out to 40 months, and that's going to drive down our yields. So I feel fortunate and wonder what I'm doing wrong underwriting if I'm winning deals today.
Quick question for you, Brad. You mentioned 40 months.
Yes.
What is that? What is the magic of that 40 months? Is that the expectation that how long these interest rates are going to stay up before they start coming back down?
No, I'm sorry. That's the paper that I'm looking at now.
Okay.
The bank paper that I'm looking at now, the maturity is out that long. So,
Gotcha.
so lenders were making fixed rate, 4.5% fixed rate loans for, 7 years.
Got it.
And I'm on the back end of that for the
You
front
got
end.
it.
Yeah, one thing we're seeing in our loan sales is the bank buyer or credit union buyer is a lot less active. Some that were buyers are now sellers and calling us about selling portfolios. So, on these portfolios that we offer, you often get a mix of non-bank buyers as well as bank buyers, and there's just less bank buyers right now for loans. Chris, I've known you for a while. You started your career in workouts, so you certainly remember 2008. How do you think this cycle compares to this one? How is it different?
Yeah, no, I mean, I see it considerably different. The last recession was driven a lot by residential development, overbuilding, land speculation. And, that was coupled with, as the recession started, an incredible lack of liquidity. At this point, the residential development slowed down 18 to 24 months ago due to input costs. The home builders were all slowing down well before any of this volatility. And aside from office properties, I'm not seeing a whole lot of cracks in the fundamentals, in the other asset types. So, it's going to be very different. We've talked about the office challenges, and, to Tim's point earlier, in many cases, some of these deals, you're looking at potential land value from a liquidation standpoint. So, that's going to be a considerably different view than, how we looked at things 2008 to 2012. The lack of liquidity, there's tremendous amount of liquidity today, but you're not going to be putting good money after bad. So, I don't see a lot of people stepping up and acquiring office properties at what would, 12 months ago have looked like incredible values.
Well, I mean, to stay on office for a minute, Chris, I mean, it does sound like you are doing office loans. I'm sure you're doing them carefully, but how are you underwriting them today, and what kind of things are you looking for?
Yeah, no, as we talked about yesterday, I created a little bit of a headache internally by growing our office book by about $75 million in the first quarter through 3 different transactions. But, they're, again, going back to my earlier comments, we're looking at opportunistic lending. So, the key has been the strength of the tenancy, the weighted average lease term, and very conservative leverage. Each of the deals that we did was sub 50% loan to value. You had weighted average lease terms that stretched out beyond 10 years, and we were looking at doing 3 and 5 year bridge deals. So we are still looking at office. I mean, and let's bifurcate traditional office from, the medical office sector, where we continue to stay active and see strong opportunities with, well-performing health systems signing long-term leases. But, in the traditional office space, it's really got to be a compelling story. And that story's got to encompass the sponsorship, and the underlying metrics of the property, coupled with a very conservative loan structure and strong pricing.
Yeah, I mean, Tim, a third of all CMBS loans are office. Obviously, municipalities are looking at zoning. What can we do to convert these buildings? Obviously, only a certain percentage of office buildings can be converted. But, what's the special servicer position when the borrower calls up and says, hey, I'd like to try a different use?
Yeah, great question. CMBS, again, and REMICs are not a good structure that allows a lot of flexibility. And there was actually an interesting article. If you're looking at some of the fixed rate CMBS loans that were originated on office back in 14, 15, again, that maturity risk that's coming up, where they were originated in a much lower interest rate environment. Converting an office building is economically almost unviable in most markets. You need to be in New York or San Francisco or even in LA that has a very strong condo and or residential market pricing structure that you could even consider the conversion of an office building. And so converting an office, and then on top of that, converting office in a REMIC CMBS structure is going to be extremely challenging. I'm going to go back again to, I think the vast majority of the workout strategies of most CMBS special servicers are either to work with a borrower and try to find the best liquidation strategy to get out of that loan and keep the trust from limiting its losses. and in many cases trying to preserve the underlying debt so that they can improve the potential liquidation price. Conversions are going to be few and far in between.
Does that basically mean no if I come to you and say I want to convert this to mixed use? Is the answer pretty much an automatic no?
You got to have a very strong case, and again, it's going to depend on the market, John. What are you going to do with a suburban office building, Class B, in a smaller market? It's going to be very difficult, very challenging.
Yeah, I mean, there's a lot of chatter about CBD office. Suburban office not so bad, downtown office bad, and I certainly see that from the banks as they do their calls with analysts. I mean, in my view, I don't necessarily see that distinction. I think a lot of the suburban office buildings that are going vacant are, circa 1992 buildings that nobody really cares about. Whereas if it's in a downtown, at least that building is cool. Someone may want to redevelop that Art Deco 1935 building. Thoughts on that from the rest of the panel as the distinction between suburban and CBD office?
Well, John, we're obviously talking about a deal in Detroit because there's believe it or not, I just yesterday I was hearing a lot of conversion of cool buildings in downtown Detroit, which 4 years ago I wouldn't have even considered being in that market, and I'm recently back up in that market. I mean, so there really is a cycle to real estate. But the one, I think Tim knows a lot better than I, but dealing within the REMIC structure is, I've found it to be impossible, and I don't focus there at all. And I was there, back in the day with Stacy Berger, Tim, your old friend, and an icon in the business. And I stay away from it. There's just not a lot of creativity involved in those workouts, and they got to get pretty ugly. But this office thing is systemic. And Chris has got a handle on it, and I think it's great. I mean, they're either going to be back in 0 days or 5 days a week, and no one's figured out, what that's going to look like yet. But it's going to change and devalue. I think it's inevitable unless you're doing it and threading the needle on the office sector. There's going to be some problems in there. And we love saying we're going to convert to multifamily, but Tim and I have talked about it. It's just that's a tough sell and an expensive repositioning opportunity there. So.
Yeah, I mean, I liken what's going on with office today and the work from home environment. And again, it's difficult to say what might happen in 5 or 10 years. Okay. And I tend to take a long-term view, but very similar to what happened to malls back 10, 15 years ago and the disruption with digital and online shopping. We have too much office. A lot of it was developed over the last 10 or 15 years in a low interest rate environment. And then you have bigger markets, metro markets, and I hate picking on New York, but by God, you've got a little C building that's been around since 1980, stuck in the middle of the block. You can't convert it to multifamily. What are you going to do with that? I mean, the term tear down has been used in many of our special servicing meetings. And so office is being disrupted, similar to what happened with retail and malls. And it's going to take a while to work through that. There is going to be a lot of distress, I think, on the office side, whether suburban or urban, for the next 2, 3, 4, 5 years.
Yeah, no, I agree with that. I don't think there's a real distinction between CBD and suburban office markets. And, I've heard the bank CEOs during their analyst calls distancing from the CBDs. Our bank has done the same thing. And, the way I view that is really just distancing yourself from the headline risk as opposed to the risk of office buildings.
Yeah.
Right.
Good point. We have a poll question. This is for banks and credit unions only. What is your institution's position on office loans? We are currently not making any office loans. We're actually considering office loans, and we will make office loans to existing customers at higher underwriting standards, I was supposed to say. While we're doing that, if anyone has any questions, please do the questions in the chat function or email, and they will get to me. What do you guys think? Surprising? Unsurprising?
I mean, I think it's on a case by case basis. I mean, which should be every one of our deals. It's funny. I'm in Tampa, and that market is certainly robust right now. A hot market with immigration, but the Class A buildings, the highest rents, they're doing fine. I mean, there's still plenty of folks that want to be in the nicest building, the nicest house on the block, the nicest building. And those seem to be doing fine. It's when you start sliding, and typically I like playing in the B space, the B minus space, thinking that everybody needs to live somewhere, whether it's their office, B minus or C housing. But there just isn't enough absorption. There's just not enough occupiers of the space to keep that machine going. So to the extent you're selective, as we should always be, I think you'll be fine.
Yeah, and Chris, you went back to your underwriting of an office deal, and you mentioned the quality of the property itself and its location and its positioning in the marketplace. What's going on is a flight to quality, what we're seeing, right? And what is also going on is a vast majority of tenants are reducing their space, whether they believe the work from home environment is going to be here long term or not. Most companies are employing a hybrid model. And they're basically saying if the CFO of that company is going, and we've done that ourselves, and we've got 20 odd offices around the United States, every one of them, we've taken less space, looked at some sort of sharing or hoteling environment, and in many cases, upgraded to a better building. Because we're trying to find a building with better amenities that's going to make it more attractive for our employees to want to come into the office. Boy, that creates a real issue, right? When you're underwriting that office building, you've got to make sure that there's a ton of capital, both for improvements as well as the ability to increase your amenity package, and that your location and your sponsorship can afford and is invested in doing that. Otherwise, I think as John mentioned earlier, you're going to see a continuing decline in occupancy for those buildings that can't meet that.
And Jim, that's exactly what happened in one of the assets that we lent on a month or two ago here. We had a Fortune 100 company that moved out of 125,000 square feet in a different building into 75,000 square feet in the building we were financing. And, seeing that movement to that specific asset gave me a lot of comfort that this is a desirable building that top companies are, going to be looking to move to.
Right.
Yeah, I suspect big users like that, Chris, are going to be owner users. I mean, if I've got a 75,000 square foot need in a major city, why would I bail out my landlord by re-signing a lease? Why not say, look, I'm vacating, so sell me the building? Because, there's probably going to be some, we saw this in Chicago with Gavi recently bought a building that, I do think you'll see some owner users look at a historic opportunity to lower their operating expenses. We got a poll question. So I got a question from the panelists about lodging. Obviously, we're now talking about an office apocalypse. There was a retail apocalypse that didn't happen. And then we all talked about a hotel apocalypse during COVID. Obviously, hotels have done much better. Anyone want to talk about what you're seeing in hospitality and defaults today?
I'm going to jump in real quick only because it with COVID, March of 20, I thought the world was going to just collapse. A few $1 trillion fix that problem. Now I'm kind of I'm typically not a hospitality buyer because of the operating component there. But we just bought one 2 weeks ago, and it's a limited service well-branded property out west, and I like it. I like the numbers. They're back in. It's a growth market. But what worries me most is we put the pips off for 3 years now, and the franchisors were generously willing to look the other way. But at what point are they going to insist, and are we going to need a refresh, new FF&E, soft goods into the property? And that borrower's not going to have the $1.3 million that it's going to take to refresh and put the PIP capital in. So that's my biggest concern with lodging right now. And I don't want them falling. I don't want the flag falling, below where it is now. But the franchisor will insist on that PIP. If they can't do it, they'll close that property. It'll become less than, and they'll open up a new one across the street.
Yeah, I also
So-
think the good news in lodging is sometimes used against the borrower. I mean, we're likely taking a large portfolio to market in the next 2 weeks, and and the biggest assets, a large new hotel loan, major flag, and they didn't do so well in 2022. So I think lenders are going to say, well, hold on a second. If your 2022 was mediocre, and that was one of the best years in the lodging industry ever, how are you going to do in a recession or some other sort of slowdown?
That's a
we're
good
not
question.
really lending too much on hospitality, very selectively, sub 50% leverage. I want to say that I've offered terms in 2 years on 2 hotels that were experiential and very low leverage. We don't have a lot in the portfolio. I'd say that half of what we do have in the portfolio is being monitored by our special assets group, but they're all performing okay. But the expectation is they can't really refinance, and they're not looking to sell. So.
Yeah, what's interesting too, again, in the lodging space, market dependent. We keep coming back to that same statement. But take a market like New York. There was so much product that was taken out during the pandemic, shut down, gone, that you can't get a hotel room in a place like New York, because even though the office occupancy is down, business travel has picked up, and you've got the tourists coming back. And so the lodging market in a place like New York has come back screaming. I bet you their numbers, like you pointed out, Chris, for 2022 and probably going into 23 are very strong. But it's going to be market dependent. You got to really look closely at the demographics. And what's interesting as well is a lot of people are now doing what's it called? They go on a business trip and take some personal time as well. And so they're mixing sort of business with pleasure. It's changing. There's a lot of things that are changing that I think are going to affect both hotels as well as office over the course of the next 3 or 4 years.
I want to come to work for Citus.
So later this summer, and for the record, Clark Street is one of a handful of vendors for the FDIC. So I probably can't say too much about this, but at some point, the FDIC is going to start disposing of $60 billion in assets from Signature Bank. To put that number in perspective, the FDIC only sold $8 billion in loans from 2007 to the present. So $60 billion is a big friggin' number. What do you guys think this will do to the market?
We're pretty close to the FDIC. Back in 2008, 9, 10, we actually built out a platform I was leading called Cohen Financial with the distressed FDIC portfolios that a number of our clients acquired, and we helped manage and liquidate. If you look at those numbers, I think the numbers that the FDIC prints out, and they use the joint venture structure, they sold approximately $24 billion of AUM during that great financial crisis. I think the numbers this time around, as you pointed out, John, are going to be significantly higher because the big banks that failed, right, the 3 big regionals that failed, and I think there's a large PacWest portfolio of construction loans that is getting disposed of in the private sector. You have all these smaller banks that still are going to, in my view, are still going to probably get taken over. And that's going to be 6, 12, 18, 24 months coming to the market. Look, as you pointed out, there's a lot of dry capital out there if the deal is priced right. And the FDIC likes that joint venture structure. I think they're going to continue to use it. They used it very successfully during the financial crisis. And they're going to use it again. And I think it's going to bring a lot of buyers, and it's going to basically reset commercial real estate pricing over the course of the next several years.
Yeah. As far as, we actually have a lot of bankers on this call. Chris, curious to see, PacWest announced a sale of $2.6 billion in loans. How do banks in general, not your bank, handle the marketing of loans and sort of managing whether they're held for sale or not?
Yeah, that's something that's very institution dependent and really ties to, how the CFO looks at it. The minute that you're starting to talk about selling a loan, that is supposed to flip a switch where it is no longer held to maturity and it's held for sale. And once a loan is held for sale, it needs to be marked to market. So, as you know, from our prior times together, when we are interested in a note sale, we are not putting a reserve price on it. We are, entering into exploratory findings as opposed to actually listing these loans for sale. And you've got to walk that fine line between intending to sell and price discovery. And, you need to lean to the price discovery, because once you intend to sell, again, GAAP would say you need to make these loans held for sale. I think, there was an article in the last week that, a number of banks have increasingly moved loans to held for sale, potentially because they are actually intending to sell. That PacWest sale, that kind of came out of nowhere to me, but, that was a significantly sized sale. I think it was 2.6 billion that sold in the 90 to 95 cent range. And I think there was about $1.5 billion of unfunded commitments in that sale as well. That's not an insignificant sale. You don't see a lot of those going to a non-bank buyer, especially.
Yeah, and the market responded very well, which proves the point I've been making for years, that banks that sell loans have better reputations than those that don't. Sometimes that's something that we deal with on a day-to-day basis. Got an interesting question from the audience regarding CRE markets. It was mentioned LA and San Francisco were the two worst CRE markets in the country. Thanks, Tim. Are there any markets in California that are attractive? I understand it's case by case, but I guess I'd answer the question broader. What cities in the U.S. are doing well that you see in your portfolios?
I mean, right now, I think Texas is still doing really well. You got to worry about some overbuilding there, but it's a very pro-business state environment. The migration that is moving out of California, and other states to Texas is significant. We've done a number of multifamily projects around Austin, around Dallas. We're seeing tremendous industrial development opportunities there. So most of the Texas markets, Houston's always its own anomaly. But most of the Texas markets have been strong. And I think recently the highest rent growth in the country, if I saw correctly, in the first quarter was actually Indianapolis, Indiana. Typically you see the Midwest, you see a lot of, stagnant growth, a lot of out migration. So I was surprised to see a number of Midwestern markets in that multifamily rent growth study that was done, but, would have never guessed Indianapolis near the top.
I'm at the MBA chairman's conference right now, and CoreLogic gave us a talk yesterday, and I was shocked. And Tim, you referenced it and started it, but I was shocked how poorly California is doing right now. I mean, it's a long way from Tampa. There's some legal issues I face there, and some underwriting issues. So I don't do a lot in California. We do have assets there, but California is really taking it on the chin right now. Anecdotally, in Tampa, I've met 7 folks that have moved from San Diego. I mean, I didn't think anybody ever left San Diego, but I mean, with taxes, with fires, I mean, there's some, even though we've got our hurricanes, maybe they're better than fires. As someone said, just pick your poison with some of the issues going on, in the environment. But I was surprised California is getting knocked up so bad right now.
Only a distressed debt investor would turn a question looking for what are the best cities into dumping some more in California.
Well, follow what Chris said. Look at the demographic shifts, right, over the course of the last 4 or 5 years, and the headlines have been all over the place. New York, Chicago, Boston, LA, San Francisco, most of California, Oregon, Portland, even Seattle. People are moving out of the high tax states that were significantly more strict in the lockdowns, and are moving towards the Southwest and the Southeast and markets. So the answer to this question here, look at the markets in those locations. Florida overall is doing very well. Brad, you mentioned Tampa. The East Coast of Florida is booming. I'm amazed at the increases in rents and even office is doing fairly well there. Look at Tennessee. Look at North Carolina, South Carolina, even Georgia and Virginia and others. So Again, what's happening, and we just got an email. Chicago is following California and now increasing by 300%, 286%, the transfer tax in any deal over $1 million. So, if you had $1 million deal and you wanted to sell it, it would now cost you about $30,000 more than it would have cost you last year. It may not become legislation, but look at what's going on in the millionaire's tax in Los Angeles. It's crazy. They keep increasing their taxes, increasing their budget, and scaring away a lot of people.
The thing that's interesting though is the Florida, Tennessee, North Carolina, Arizona trade, where you leave your high price city, you go to Florida, and you save 30 to 40%. That's pretty much gone. In fact, I've got a good friend who moved from Chicago to Tampa, and he claimed he had the most expensive 2-bedroom in Chicago. Well, he's paying $1,000 more now in Tampa. So I do think you might see momentum stall a little bit because the prices have gone up so much in these areas.
Yep.
I always tell my credit partners, rent growth declining still means that rent is growing. So.
We had a poll question. I'm curious to see what people are lending on. This is for the lenders on the call. What area of lending is most desirable to you now? We can only put 5 in here. Multifamily, industrial, office, retail, hospitality. No office.
Surprise there.
There you go. Multifamily, industrial, clear, far away. I mean, we haven't touched on industrial at all. Aside from higher rate distress, are we seeing any challenges in industrial markets that you guys are seeing?
Yeah, challenging is maybe a little too strong a word, but you did a spec industrial deal 2 to 4 years ago. That was leased before it delivered. I think we're seeing more projects that are leasing post-completion, still well within normal absorption timelines, but the leasing has slowed a little bit. We're seeing projects that are leasing 6 to 12 months post-completion, whereas, like I said, 3 to 5 years ago, they were leased before they were complete.
Yeah, and given the run-up in prices and values, it's a challenging asset for people to come in and invest in, probably lend on as well. You just need to be a little more careful. As Brad said, 2 or 3 years ago, it was a no-brainer.
Yeah, prior to the call, one of the attendees sent me an email. This is a sub-billion-dollar bank in North Carolina, and their comment to me, and this is really for Chris. Not sure if pricing is in the scope of call today, but one of the challenges in CRE lending for us is pricing. I have heard that banks are using their marginal cost of fund as they index stay for pricing. That is 5% time deposits, regardless of the fixed term of the loan. Adding a spread of 200, 300 basis points puts that rate out of reach given our competition. I'm constantly reminding lenders that we could purchase Fannie and Freddie MBS 15 years to yield 5%, and that's not what they want to hear. Chris, do you want to address kind of the pricing in CRE and construction?
Yeah, look, I'd say that it's a bifurcated market. And, you mentioned a sub-billion-dollar institution. I don't really know exactly where to draw the line, but, call it the sub-$10 billion bank. I think that there's still a lot of competition and aggressive pricing to drive asset growth. Whereas, in that greater than $20 billion space, more the regionals, the market's pulled back and, pricing is less competitive right now just because of the lack of lenders that are active. Our bank runs a unique model in that, I work at our holding company, but we effectively own 11 community banks across the western half of the U.S. that each range between, $750 million and $3 billion. So, a lot of our lenders that work at our individual banks are seeing significantly more competition, significantly more aggressive pricing than what we're seeing kind of at the top of the house holding company looking at larger opportunities. So, I think that they're right. The competition right now in that smaller bank space is very difficult. It is very competitive. The larger space, there's less competition, but we're seeing lenders that are still issuing term sheets at 65 to 70% loan to cost on a construction loan priced at 250 to 275 for a deal that's under 15, maybe as high as $20 million. And those are terms that just aren't anywhere close to what we're looking at today. But, my lenders at our various banks are competing against that. And, for the most part, unsuccessfully, unfortunately.
Yeah, I mean, certainly anyone can do a loan under $10 million and it gets very competitive. Couple questions I'm going through. Somebody asked, let's pull this one up. Hold on. It's the capital availability. For the capital availability graph we saw earlier, there was a V-shaped recovery post-global financial crisis. Do we see a similar recovery in the next 8 to 12 months?
I think it's going to take a lot longer than
rapid recovery.
I think it's going to take a lot longer than 8 to 12 months here, to figure this out. With the office issue looming, being a third of outstanding debt, at least in the CMBS space, it's probably similar across all other sources, obviously, other than the Fannie Freddie. But it's going to take a lot longer than 8 to 12 months, I believe.
Yeah, I think you're right. The biggest issue that I see is lack of transparency in how far the Fed may go and how long interest rates may stay high. But gosh, we're going to date ourselves, Brad. You talked about the 1955 to present average of 6.8%. I think you said for prime prime rates. I remembered when I bought my first home, and I assumed a 13 3/4 mortgage, and I thought I had died and gone to heaven when prime was 18 in the late 70s, early 80s. So, people have gotten used to low interest rates. The question I have, and again, my crystal ball is cracked and cloudy, where are interest rates going to be 6, 12, 18, 24 months? Do people really believe that the Fed is going to raise and then have to lower it? They keep talking about a recession, but there's a lot of signs that say we're not in a recession, and there's a lot of signs that say we are entering in a recession. So I don't know. It's going to be interesting to see, and until there is more transparency, more clarity where interest rates are going to go longer term, I don't think that capital is going to jump back like it did after the great financial crisis. As Chris said, I think it's going to take some time.
Well, if you saw in the global financial crisis, the recovery was very slow. So I think the proper question was, it was more of an L-shaped recovery, and we got a V-shaped recovery after the COVID recession. I mean, it does seem like the inflation issue will be out there for a while, and it seems difficult. I think we're likely to get a mild recession. I think the recovery is going to look a lot like 2008, where we just kind of lip around for a few years. We make 1 to 2% in GDP, but it's not anything to get too excited about.
Mm-hmm.
But that capital availability line is going to keep going down. I agree with my colleagues on this panel that I think we're in for some more tougher times before we see anything close to a V. We're talking about a longer term recovery. I'm looking at 8 days and exactly 29 seconds when the Federal Open Market Committee meets again. And while I think we're going to take a pause, inflation is still not transitory. I mean, it's a problem. And I don't think the Fed knows exactly what to do about that.
Yeah. 10 million open jobs for the May employment report. Employment continues to be very strong. And I think the article I read that I think is indicative, people are kind of hoarding employees. They're not letting them go like they used to because they had such a difficult time hiring them. And that's going to continue to keep pressure and certainly inflationary pressure from that standpoint.
Chris, any macro view?
No, I mean, look, I'm competing against half as many banks as I used to. And until the banks that I'm used to competing against are back actively lending and opening up the spigot on their portfolio, we're going to see this malaise for a long, extended period of time.
Great. Well, this has been an excellent panel. We're right at the hour, so I want to thank everyone for participating. Thank you, Coleman, for hosting this, and we will definitely bring this cast of characters back in a few months. This has been a very engaging dialogue, and we look forward to the next one. So thank you, everybody, for coming, and thank you, Tim, Brad, and Chris, for participating.
Thanks, John.
Well,